Two NRIs invest the exact same amount in India. Same mutual fund, same years, same identical returns. One invested through an NRI account, the other invested through the savings account he had actually opened since his college. He never told the bank he had moved. 10 years later, one of them moved his money back abroad in 3 weeks, the other still hasn't. Same investment, completely different ending. So, let me ask you something. If you send money to India today, would you know which account to route it through? Would you know how it gets taxed, not just in India, but in the country you actually live in? And 10 years from now, when you actually want that money back, are you certain you could bring it out easily? If you hesitated even once, you are in the majority because the mistake NRIs make isn't picking the wrong fund, it's investing before they understand the rules that decide whether the money can ever come home. By the end of this video, you'll know exactly how to set up the right banking structure before you invest even a single rupee, which investments make sense in 2026, and what changes this year, and the one framework I would run before putting any money into India. By the way, I'm Nikhil. I'm a chartered accountant by profession with nearly 2 decades of experience with EY, PwC, and one of India's top wealth management firm before launching my own startup. And this is Finicky, where I simplify money the same way I practice it. Let's start with the question underneath all of this. Why India? If you have lived abroad for a few years, most of your money is probably already in the country you actually live in. The S&P if you're in the US, the TSX in Canada, the FTSE in the UK, deposits in global funds in the UAE, nothing wrong with that. Keep investing where you live. But diversification just isn't about owning different stocks, it's also about owning different economies. Look at the US market. Enormous wealth over the last decade, but a huge share of that came from a handful of technology companies. Apple, Microsoft, Nvidia, Amazon, Alphabet. So ask yourself honestly, if your whole portfolio sits in one market and that market is being carried away by few companies in one sector, how diversified are you really? India looks different. Manufacturing, banking, IT, pharma, consumer, infrastructure, energy. When one sector slows, another often picks up, and the long-term story is intact. A young population, rising incomes, urbanization, infrastructure spending, millions of first-time consumers entering the formal economy every year. These are decade-long trends, not one-year trade. But your biggest edge isn't India's growth, is that you understand India. You know which brand people trust, you understand festive spending, you can spot a business becoming part of everyday life long before it shows up in a research report. A fund manager sitting in New York cannot. So yes, India deserves a place in your portfolio. Now, one honest boundary before we go further. This video is about how to invest in India correctly, the right account, the tax, the traps that catch people. It's not about how much of your total portfolio should sit in India versus everywhere else you invest. That's a real question and it actually deserves a video of its own. Let me know in the comments if this is something that I should do next. But before you buy a single fund, you need to get one thing right. And this is exactly where our second NRI lost. Every NRI keeps asking me the same questions. Which fund should I buy? Should I buy stocks? Is property better than equity? Almost nobody asks the one that actually matters. Where should my money sit before I invest? Because your banking structure decides how the money moves, how it is taxed, and whether you can actually ever get it out. 3 accounts: NRE, NRO, and FCNR. Now, say you work in Dubai, your salary comes in dirhams, and you want to send some to India. That's an NRE account. Your overseas earnings account. Money earned outside India goes here. And the money is fully repatriable. Send it back abroad whenever you want. Now, change the situation. You own a flat in Bangalore and your tenant pays rent. Or you get a pension or dividends. That's money generated inside India. That doesn't belong in an NRE account, it actually belongs in an NRO account. And here's what NRO actually costs you. From an NRE account, money leaves freely, no cap, no certificate, but from an NRO account, you can repatriate up to $1 million per financial year. That's it. There's a catch though. The limitation is on capital transactions such as sale proceeds or capital gains, but your current items like your rent, interest, and dividends are not subject to the 1 million cap, and it's freely repatriable. Now, go over this limit and you need RBI approval, which, let me be very honest, is very rare. And before a rupee moves, you need to file Form 145 and Form 146, which is a certificate from a chartered accountant confirming you paid Indian tax. In one account, the money just leaves, no restrictions, but on the other, you need a CA, 2 forms, and a cap you didn't know existed. Remember that account I mentioned at the start of this video? That second NRI never opened an NRO account at all. He kept using his resident savings account he actually opened since his college days. Salary out, rent in, nothing looked broken, except under FEMA, the day you become an NRI, you're not permitted to hold a resident savings account. It has to be redesignated into an NRO account, not eventually, but immediately. He never did it, so for 11 years, every rupee flowed through an account he wasn't legally allowed to hold. And when he finally tried to move his money abroad, the bank had to unwind all of it. Where did each of the credit come from? Indian income or foreign income? Which year? Which was tax paid? He had no clean answer, so it was a mess and the money couldn't leave. And the penalty under FEMA for holding funds you weren't permitted to hold can go up to 3 times the amount involved. He didn't pick a bad fund, he picked the wrong account and never told his bank he moved abroad. It's actually a free fix, and it takes just informing the bank, and almost nobody makes it. Now, the third account, FCNR. And to understand it, we need to talk about the currency. Say you put your money in an NRI fixed deposit paying around 7%. Attractive, but your money is first converted into rupees. And if the rupee weakens against your home currency over the next few years, part of that return quietly disappears when you convert back. You earned 7%, that's not what you took home. An FCNR deposit stays in foreign currency, be it dollars, pounds, euros, no exchange rate risk. Simple rule, NRI FDs maximize rupee returns, FCNR protects your currency except for this limited window that you have now. If you're spending the money in India, NRI FD makes sense. Spending it abroad, then FCNR makes sense. Here's the part that catches almost everyone. Invest NRI money into stocks or mutual funds, sell years later, and the proceeds come back fully repatriable. Simple, but use that same NRI money to buy a house, sell it years later, and the sale proceeds are generally credited to your NRO account. That means the money went in fully repatriable, but it's coming out with a cap, which is the 1 million cap. When a resident sells property, the buyer deducts 1% TDS. When an NRI sells, the effective deduction can go up to 14.95%, including surcharge and cess for long-term properties, that is, properties held for more than 2 years. But that's not the painful part. It's deducted on the entire sale value, not on your profit. On the whole amount, say, for example, sell a flat for 1.5 crores, where your actual gain is only 40 lakhs, your real tax is around 5 lakhs. But the buyer deducts over 22 lakhs because he's deducting on the full sale price. Over 17 lakhs of your money now actually sits with the income tax department, and getting it back can take a year. There's a fix, a lower withholding tax certificate. You can apply before the sale and the buyer deducts on your actual gain instead of the gross value. But you must apply in advance. After the sale, it's way too late. And one thing to know, if you're selling this year, from April 2026, India is running on a new Income Tax Act. The rules are broadly the same, but the section numbers and the forms have changed. So, if your broker or your advisor is still quoting Section 195 and Form 13, they're working off the old law. Paperwork gets rejected, timeline slip, and your money sits with the tax department. That's a real lesson with real estate. It's never just a purchase. The tax, the cash flow, the repatriation rules, they all show up later, usually right when you're trying to sell. Before we get to where your money should actually go, a small request while I have you. If this is helping you, hit the like button and subscribe, and also the hype button next to it if you can actually see it. That genuinely helps this video reach more NRIs who are quietly making the same mistakes that you are avoiding by watching this video. And there's something bigger as well. Over the last few videos, I floated an idea, a podcast with our own community where real NRIs come on and talk through the situation they are actually stuck with. Not theory, the real thing. The ways to invest in India, the R&R window that nobody told about, where the money should sit, property back home, when to finally move back for good. And the point isn't to discuss it. The point is to sit down together and solve as much of it as we possibly can in that one conversation. The response to that idea has been genuinely encouraging. So my team is actually trying to put this together. But if you want to be part of that conversation, stream right here on the channel. There's a Google form in the description. Tell me your story and my team will reach out to you quickly. So where to actually invest in 2026? There's no best investment. There's only what's right for you. So let's go through each one and answer a single question. Who is this actually for? Fixed deposits. Predictable, no market swings, but don't look at only the interest rate. If you'll be spending that money abroad, a weakening rupee can eat a high return. That's where FCNR actually wins. FDs are for your emergency funds, short-term goals, and the debt part of your portfolio. For a retirement 20 years away, they won't beat inflation. Mutual funds. For most NRIs, this should be the core because investing isn't about finding the next multiplier, it's about staying invested. You get diversification and professional management in one product, and you can SIP into it every month. One exception, and it's important. If you live in the United States, understand the PFIC rules. Many Indian funds are treated very differently under the US tax laws, which can mean heavy reporting and unfavorable treatment. Now, that doesn't mean you avoid India, it means structure it properly first, which is basically what this whole video is about. See, US was an example only here. Similar rules exist in UK and other countries as well, so talk to your local advisor. Direct stocks. If you genuinely enjoy analyzing businesses, go ahead. Platforms have made it largely digital now, but one warning. Don't confuse familiarity with expertise. Knowing a company is not the same as valuing it. Great businesses bought at a bad price still deliver bad returns. Unless you enjoy the work and can sit through volatility, a fund is a better answer. GIFT City. Traditionally, you had to convert your foreign currency into rupees before investing in India, but GIFT City lets eligible investors invest in foreign currency directly with attractive tax treatments on certain structures. It's still evolving, so whether it fits depends on your goals. I've made a full detailed video on it. Watch that one after this. Gold. Buying it emotionally is different from buying it as an investment. Skip physical jewelry, making charges, storage, insurance, purity, but use gold ETF. If not, at least buy gold bars, never jewelry. Gold is a hedge against uncertainty, not your wealth engine. It belongs in your portfolio, just not in a big way. I would say not more than 10%. Real estate. Let me be direct. Most NRIs who buy property in India don't buy it because the numbers work. They buy it because a parent asked them to, maybe because a cousin bought one, because there's a quiet feeling that if you don't own something in India, you have let go of India. That's a real feeling. It just isn't an investment thesis. Low rental yields, tenants managed from another time zone, maintenance, property tax, paperwork, and on exit, the deduction and the repatriation route we just walked through. If it will be your home when you return, buy it. That's a good life decision. But if you're buying it to build wealth, run the numbers first and be honest about whose decision it really is. Startups and AIFs, exceptional returns with exceptional risk. Most startups fail, your money is locked for years and minimums are high. This is a icing, not the cake. Build the core first. Now that you have a broad flavor of investment avenues, the biggest myth NRIs hold is that if they live abroad, India won't tax their investments. Not true. Depending on the asset, you may face capital gains tax, dividend tax, or TDS, and that's only half the story. Many countries tax your worldwide income, so your Indian investment may need to be disclosed where you actually live too. And these aren't small numbers. Interest on your NRO account is taxed at 30% TDS plus cess, but under the India-US, India-UK tax treaties, for example, that rate drops to 15%. But only if you furnish a tax residency certificate and Form 10F or Form 41 under the new Act. Half the tax for two documents most NRIs never heard of. Now the change that makes 2026 different. On 8th July, the CBDT, which is the governing body of tax, issued an order authorizing the Income Tax Department to upload the financial information it receives from foreign tax authorities directly into your AIS and Form 26AS. Let me translate that. India has been receiving data on foreign bank accounts and investments from over 100 countries for years. But that data sat inside department. You couldn't see it. And most people assumed nobody was looking. Now it's getting uploaded straight into your own tax statement next to your salary TDS. Going back to 2022, here's what I would want you to hear carefully, because a lot of the people are getting this wrong online. If you are a genuine non-resident, this is not aimed at you. The data is exchanged based on the tax residency you declared to your foreign bank. If you told your bank in Dubai that you are a tax resident there, that data flows there, not to India. It becomes your problem in exactly two situations. One, you move back to India because once you are a resident and an ordinarily resident, every foreign account you hold must be disclosed. And now the department has the data before you even file. Two, your residency declaration to the foreign bank is wrong or out of date. That happens more than you would actually think. So, if you're planning to come home in the next few years, fix your foreign accounts now, not after you actually land. The good news is India has double taxation avoidance agreements with most countries, so you shouldn't be taxed twice on the same income, but claiming that relief needs documentation and planning. I've actually covered India's DTAA country by country in a separate video. Find the one for where you actually live. The takeaway is simple. Never decide on a pre-tax returns, decide on what you actually keep. So the biggest mistake NRIs make isn't about choosing the wrong investment, it's treating cross-border investing exactly like investing as a resident Indian. Every decision you make touches your banking, your taxes, your currency, your repatriation and your long-term plans, usually all in the same breath. That's why the smartest investors don't start by asking which mutual fund to buy, but they start by asking, is my structure right? Now think back to the two NRIs we started with. Same money, same funds, same returns. One of them can bring his money back home, the other can't. Nothing about that was decided by an investment. It was actually decided before the investment by a bank account and the simple communication he didn't make with his bank. India is one of the best long-term opportunities in the world, but the people who actually benefit from that growth aren't the ones chasing the highest returns. They are the ones who understood the rules before they put their money to work. So before you send a single rupee to India, go back and fix the foundation first. And if this was useful, share it with another NRI planning to invest in India. It could save them from a very expensive mistake. And comment if you have any questions. I read every single one of them. That's it from me. I'm Nikhil. Subscribe to learn how to make your finances less tricky with Finicky. Thank you for watching and I'll see you in the next one.